Hello friends, so today we will start discussing all the ICAI study material questions related to a new chapter, that is Forex exposure and risk management. This Forex chapter is very important from the exam perspective. Every attempt usually they ask questions from this area. Okay, so let's get started. Take question number 1. The price of a bond just before a year of maturity is 5,000. Its redemption value is 5,250 at the end of the set period. Interest is $350 per annum. The dollar appreciates by 2% during the set period. Calculate the rate of the return. See, this question is regularly asked in MCQ also. Now you have MCQ also. This question can also be asked in MCQ. In the May 2024, they asked this for MCQ. See, here we have two assumptions. If investors is US investor, and there will be no then there will be no impact of appreciation, dollar appreciation. See what they are asking now. You invested 5,000 and the value today become 5,250, which means they are asking us to compute rate of return. I told you return is nothing but okay, P1 minus P0, this is the capital gains portion plus the interest portion. Okay, plus the interest. How much is the interest? 350, right? So plus interest, this capital gains plus interest divided by your opening price P0, which is 5,000, right? This is how you compute return in terms of percentage. If see, they have just asked to calculate the rate of return, but if you see that MCQ which was asked in May 2024, there they've asked, okay, by assuming that there can be this question can be also solved by assuming the investor to be US investor or domestic Indian investor. See what happens. If the investor is US investor, which means I am living in US and I am putting this money, okay, into this US based bond. Agreed? So price at the end 5,250 minus 5,000 plus 350, which is, this is capital gains portion and this is interest portion, divided by P0 5,000, you will get the return as 12%. If I am an US based investor, my return will be 12%, no change, okay, due to appreciation in the currency. See, this person, if he lives in US, he will not be exposed to forex risk, hence the return will be 12% fixed. Assume for US and here for a US investor, the return shall be as 12% and there will be no impact of appreciation in dollar. Now if he is an Indian investor, okay, if dollar appreciates by 2%, the return for the non-US investor, okay, will be the return which is basically earned by the security in the US, that is right. But apart from that, you will also consider the return gained from appreciation of the dollar, which means, see, today dollar, okay, what happened? Dollar appreciates by 2% with respect to this currency. It may be India or some other country, whatever is the country, dollar appreciates by 2%. How to find the return? Very simple. I told you in international Fisher effect, there is a formula. So 1 plus money rate is equal to 1 plus real rate. Okay, 1 plus real rate plus into 1 plus inflation rate. Like this you have a formula, na? Similar way here also what happens, okay, the money rate is what you need to compute. Like this you need to understand. So here real rate of return I earned from the instrument is 12%, so 1 plus 0.12 into 1 plus, okay, the appreciation, dollar appreciation 0.02, okay, you get 1 plus, take your calculator, okay, 1.12 into 1.02, how much is that? 1.1424. This is 1 plus this money rate, required rate, correct? So to get the money rate, you will simply, okay, reduce this 1 minus 1, you will get 0.1424, which is 14.24%. Are you understanding how we are calculating? Okay, take question number 2. ABN AMRO Bank Amsterdam wants to purchase 15 million against US dollar for funding their Nostro account with Canara Bank, New Delhi. Assuming the interbank rates of US dollar is rupee 51.3625, 50 bid rate 51.3700 is offer rate. What would be the rate Canara Bank would quote to ABN AMRO Bank Further, if the deal is struck, what would be the equivalent US dollar amount? See, in some of the solution, okay, in one of the book, I think in the previous edition, this is the Institute's May and September edition book, okay. Here they would have given one more answer which they have changed, and I think now there is no alternative given. This is the correct solution and they have given this, okay. That is, I just wanted to mention. Next, see, in question number 2, okay, see, this is Amsterdam. Amsterdam is in Dutch country, no? So Holland. So Amsterdam, they have this ABN AMRO Bank. It wants to purchase rupees 15 million against US dollar for funding their Nostro account. First, before that, you need to understand here what is Nostro, Vostro and Loro account. Briefly, I'll explain. One more question is coming, hence I need to discuss this. Briefly, I'll just explain. See, if there is Indian bank, say this is Indian bank, say SBI, you have Indian bank, okay, Canara Bank, all these banks are in India, na? Right? Now, it will have in the US, this is US country, assume this is US, and here Citibank, so many foreign based bank, okay, where you can deposit and withdraw dollar. So Indian bank will have their dollar account with another US based bank, say this Citibank, assume Citibank, there they will have dollar account. Are you all understanding? This Indian bank will have dollar account. Now, this is called as, okay, Nostro account for the Indian bank, Nostro account, my account with you. What is this called? My account with you, which means Indian based company, okay, so it is, say, assuming it is depositing some, it wants to deposit or receive some dollar, it will have the account in Indian bank, but that Indian bank will have account in US based bank, Citibank, or which will be, okay, located in US. Now, this Indian bank will have account in their bank now. This is called as Nostro account, our account with you, which means my account with you. Are you all understanding? This is Nostro account. The perspective only changes, but the same thing remains. See, Nostro account, na, which means dollar account I opened. For them, if you see, this is, if viewed from Indian bank's perspective, this is called as Nostro account. Now come to US perspective. US bank is there, Citibank is there. Citibank will say that your account with us, which means your account, which means the Indian bank's account is with our country, our bank. Are you all understanding what I am trying to say? Which means your dollar account is with us. Agreed? The same Nostro account is from Indian bank's perspective will become a Vostro account from Citibank's perspective. Vostro account. What do you mean by Vostro account? Okay. Your account with us. Are you all understanding? Now, sometimes what happens, there is a third party, say this is Indian bank and this is US based Citibank. Now assume there is HDFC bank, which is located in India, which is trying to facilitate the trade between the Indian bank and US based bank, which means, okay, there could be some trade, the cross currency exchanges and all those trade will happen, okay, wherein another bank could facilitate the trade between these two banks. The Indian bank and Citibank will deal, but this transaction, okay, will be facilitated by a third party, say assume HDFC bank. HDFC bank is facilitating the Nostro account transaction between Indian bank and Citibank. This is called as Loro account. This is Loro account, which means, okay, Loro your account with them, which means from this perspective, from HDFC bank's perspective, Indian bank is other party, it is also third party, Citibank is also third party, which means it is just a facilitator. Your account, which means Indian bank's account with them in the sense Citibank. Like this HDFC bank's perspective, if you see, this account, okay, is nothing but Loro account. Are you understanding the same? See, the Loro account, I am saying from this bank's perspective, but really speaking the same Nostro account, which means Nostro account for the Indian bank. If you see from Indian bank's perspective, it becomes Nostro account. Citibank's perspective is the same transaction, same account becomes a Vostro account for Citibank, and the same account becomes Loro account from a third party perspective, which is from the HDFC bank's perspective. Are you all understanding? This is Nostro Vostro and Loro. Now we will understand the question. See what happens. The ABN AMRO Bank, Amsterdam, wants to purchase 15 million against US dollar, funding their Nostro account with Canara Bank, New Delhi. Which means the Amsterdam Bank, which is present in Europe, okay, it wants to purchase 15 million rupee. Are you all understanding? This rupee account, it opens in Canara Bank na, which means this is Nostro account from the perspective of Dutch based bank, which is Amsterdam based bank, ABN AMRO Bank. From this perspective, from ABN AMRO's perspective, this is Nostro account. This is nothing but Nostro account. Are you understanding? So very simple terms what the question requires. It wants to purchase 15 million by paying US dollar. Are you listening? Only thing is US dollar rate, bid rate given, offer rate given, which you will take. See, first question. Now, the rate quoted, okay. Now the rate quoted is from the Canara Bank, correct? Rate quoted by the Canara Bank. Canara Bank is quoting the rate, which means you tell me this is direct quota, indirect quota, direct quote. This is a quote for a foreign currency in so many units of home currency, which means foreign currency here is US dollar. For the Canara Bank, US dollar is a foreign currency. Quote given is for foreign currency. 51.3625, this is for $1. For every $1, this much rupees you have to pay, which means this Amsterdam Bank wants to purchase 15 million rupees a dollar or rupee, which means it wants to sell dollar. Are you understanding? If this sells dollar na, okay, what rate should be used? See, this is customer, ABN Bank is customer selling rate, okay. Customer wants to sell dollar na, it would be sold, okay, from the for the dealers buying rate, at the dealers buying rate, which means dealers buying rate here is what? See, 51.3625, that would be given. See here what it is given. Yes, 51.3625. Lower of the two, you should understand conceptually. Lower of the two, it might be higher also if it is indirect quote. Canara Bank is quoting it as direct na. So 51.3625 is the rate you will consider, which means 15 million, okay, rupee divided by 51.3625. How many dollars I need to sell? $292,041.86 I need to sell to purchase 15 million INR. Are you all understanding? This is a question number 2. Come to question number 3. XYZ Limited Bank, Amsterdam wants to purchase 25 millions against pound. Same question, different perspective, against pound for funding their Nostro account, and they have credited Loro account with Bank of London. I told you na, HDFC Bank like that. Some other bank is there which is facilitating the trade. If you notice in this question, okay, yes, of course, calculate the amount of pound credited, ongoing interbank rates as per dollar 61, this is per dollar 61.3625 rupees, and per pound, okay, dollar per pound is 1.5260 and 70 bid rate and offer rate given. Now see what is happening in this question. If you notice, this is the same Nostro account. The same Nostro account, they want to purchase instead of 15 million, 25 million. That is correct. But they want to purchase it against pound. See what happens in this case. ABN Bank is there, Dutch based bank, and it has a rupee account. Assume Canara Bank is there, okay, Canara Bank is there, and it has rupee account in this bank. This is called as Nostro account. It wants to purchase rupees 25 million from this Canara Bank, but the problem is that, okay, it wants to purchase by paying pound, but the quotation given, okay, is only available with the Canara Bank, assume is only rupee per dollar quotation is only available, which means I want to buy rupees by paying pound, which I cannot do na. So this transaction, to facilitate this transaction, there is one more bank which is facilitating the transaction, Bank of London. What they do now, what they say, okay, see, for them this same Nostro account becomes Loro account. That is what they mentioned in the question. Loro account, now don't get confused. Same Nostro account becomes Loro from their perspective. Okay, so what happens? This ABN Bank, what it does now? It deposits its dollar, pound with Bank of London, which means it has pound na. This pound it will sell. and get the dollar. After getting the dollar, with the dollar, it will sell the dollar and buy the rupee. Are you all understanding what is happening? See the question, now you will have absolute clarity. XYZ Limited, Amsterdam, wants to purchase 25 million against a pound, right, for funding the Nostro account, and they have credited a Loro account with Bank of London. Are you all understanding? Now, calculate the pound credited. How much pound I need to pay? Simple line, simple terms, what they are asking. How much pound I need to pay to get 25 million rupees? Now, this is where you need to apply cross rates. Whether you have quotation directly for rupees per pound, no. So, quotation for rupees in terms of pound is not given, which means what you do, this bank has pound, this pound will be converted into dollar, then the dollar will be converted into rupee. Are you all understanding? So pound is there. First I need to sell my pound in order to buy rupee. Agreed? If I sell my pound, okay, you tell me there are bid rate and offer rate. This is 1.5260 and 1.5270. This is the quotation. Now, if you sell your pound, whether the banker will offer you 1.526 for your dollar, 1.52 for your pound, or 1.5270 per pound, 1.5260. Are you all understanding? This is what they have given. Per dollar per pound, 1.5260. Next to come, you have to sell dollar, so you will get 1.5260. Now you have dollar in hand. When you sell the dollar, you tell me for every dollar, the bank will give you 61.3625, 61.37. This you need to understand. You have dollar in hand, you will pay dollar, you will sell dollar and buy rupee. You tell me which rate you should take. Okay, 61.3625. See here what they are given, 61.3625. This is the bid rate you will be considered. So which means, okay, in terms of rupee they have converted, this is the rate you should consider. Of course, if rupee per pound means this is the rate you should consider. Now, if pound per rupee means, okay, 1 by 1.526 into 1 by 61.3625, you will get, okay, 0.0107. Are you all understanding? If you multiply this with 25 million, okay, and for each rupee you will get this much pound, you have to credit 2,67,500 to get the 25 million or 250 lakhs of Indian rupees. Are you all understanding? Little bit tricky, but once you are comfortable with picking the rates, thereafter there is no issue. Question number 4. ABC Limited of UK has exported goods worth Canadian dollar 5 lakhs receivable in 6 months. The exporter wants to hedge the receipt in forward market. The following information is available. Okay, spot exchange rate is given. Interest rate is UK, interest rate in Canada. The forward rates truly reflect the interest rate differentials. What is the meaning of this? I told you this is nothing but, okay, the quoted forward in the market, if you go to the market and the quoted forward is as per IRPT, as per interest rate parity forward, which means the fair forward and quoted forward are one and same. Forward rate truly reflects the interest rate differentials. Find out the gain or loss to UK exporter if Canadian dollar spot rates declines 2%, gains 4%, or remains unchanged over next 6 months. The question that is being asked. See one thing. Now, this company is based on UK, and worth export, yes, Canadian dollar, this much is there, receivable after 6 months. Now, the rate quoted, you should always verify whether there is a direct quote or indirect quote, which means UK based company. Okay, I also told you, whenever, if you see, all the market would be quoting direct quote only. If you are in India, the quotes will be given for dollar, foreign currency only, the quotes will be given. But in UK alone, I told you, the market operates little bit different. There, they will give the quotation for pound. They will give quotation for pound. For their currency, they will value other currency. Are you understanding? Which means here, Canadian dollar 2.5 per pound, which means is in UK means this is not quote for a home currency, which means this is indirect quote. This is indirect quote, okay, for UK. And interest rate in UK is given, interest rate in Canada is given. Now, the point is, forward rates truly deflect. Yes. Now, first thing, you need to find out the, the forward rates quoted for, see, the forward rates truly reflect the quoted forward rate as per IRPT forward. First step is computation of IRPT forward, which means interest rate parity. How will you spot into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. This you will apply provided the quote is direct quote. Are you understanding? If the quote is indirect quote, simply, okay, you will reverse it, which means spot into 1 plus interest rate of foreign currency divided by 1 plus interest rate of home currency. This you will apply and you will get the corresponding IRPT forward. Are you listening? First step, see here. If you see the forward, first step, forward rate, we need to compute as per interest rate parity theorem. Yes. Here also, the respective 15% is the, and wherever interest rate is given in our subject, it should be treated as annualized interest rate percentage, which means here, the forward is for receivable in 6 months. 15% is per annum interest, 7.5 is, okay, for 6 months. Here also 12% for 6 months, interest rate is 6%. So, 1 plus interest rate of foreign currency, which means in UK the foreign currency is Canadian dollar, which means 7.5 is the interest rate in Canada. That you will consider 1 plus 0.075 divided by 1 plus 0.06 will give you this Canadian dollar 2.535 per pound. This is nothing but forward rate. Okay, now what we will compare, what if the spot rate is declined by 2%, what is it? Now current spot rate is 2.5 Canadian dollar per pound. Now what they are saying, if yes, Canadian dollars declines by 2%, that is the understanding. See, very simple. If Canadian dollar depreciates, what will happen? More Canadian dollar you need to pay to get every pound, which means 2% more Canadian dollar you need to pay. Up to 2.5, earlier I had I need to pay 2.5 Canadian dollar to get 1 pound. Now I need to pay 2.5 into 102% or 1.02. How much is that? Canadian dollar 2.55 per pound. This is the spot rate if it is declined by 2%. Are you understanding what I am trying to say? Which means in this question, what they are saying, okay, find out the gain loss to the exporter, which means it is assumed that exporter has taken forward contract, and now you need to see, okay, after the 6 months, if the spot rate, real spot rate declines by 2%, gains by 4% and remains unchanged. Under these 3 scenarios, what happens to your gain on loss because of this forward rate agreement? That is a question. So, pound receipt as per forward rate, Canadian dollar 5 lakhs divided by Canadian dollar 2.535. How much is that? Pound 1,97,239. Okay, and pound receipt as per spot rate. This is as per forward rate, which we computed here. Are you understanding? Now, spot rate, now the revised spot rate which you computed here, if you see the receipt is 1,96,000. You tell me which has higher receipt? Okay, 1 lakh forward rate, which means the gain or loss or gain. Gain due to forward contract is 1,161. Are you understanding? Now, if spot rate gains by 4%, you tell me if sorry, if Canadian dollar gains by 4%, you tell me what would happen. If Canadian dollars gains by 4%, you should pay 4% less Canadian dollar to acquire 1 pound, which means you should pay 2.5 or less than 2.5 or less than 2.5. How much is that? 96% of 2.5. 2.5 Canadian dollar into 96%. Okay, you have to pay for every pound if a spot rate declines by 4%. So, Canadian dollar 2.4 per pound is the value. Now, pound receipt as per forward rate, okay, anyway, 2.535 we already computed, that will remain same. Pound receipt as per spot rate, 2,08,333 pounds, which is, okay, loss again loss to the extent of 11,094. Are you understanding? You are having less receipt when the spot rate changes by this. Natural, na? If spot rate remains unchanged, if spot rate, today's spot rate, what is today's spot rate? Okay, 2.5 per pound, na? If that remains unchanged, okay, 5 lakh Canadian dollar divided by 2.5, the pound requirement will be, the pound receipt would be 2 lakh as per the current spot rate itself if it is remained unchanged, and receipt would be 1,97,239 as per forward rate. Okay, loss again loss to the extent of 2,761. Are you all understanding? Okay, so this is the question. Next, take question number 5 for discussion. On April 3, 2016, a bank quotes the following. Spot exchange rate INR 66.2525, INR 67.5945, bid rate and offer rate. 2 months swap point, this is spot bid rate and spot offer rate given, 2 months swap points given, and of course 3 months swap points is also given. In a spot transaction, delivery is made after 2 days. Assume spot date as 5th April, no issue. They are saying even though on April 3rd it is quoted, on 5th April only delivery will happen, actual delivery will happen. Assume one swap point is 0.001, which means 4 decimals they want to consider. The 70 and 90 you will add from the last 2 digits, which means 66.2525, 66.2525, say 70 bar 90. This is ascending swap or descending swap? Ascending swap, which means the swap is premium swap. You have to add 66.2525 plus 0.0070. This is the understanding. Are you understanding? Okay, 9525, 66.2595. Like this, you need to understand. Okay, you are required to ascertain swap points for 2 months and 15 days for June 20. So, which means today is April. What is that? Yes, the quotation is given for spot quotation April 3, but of course the assumed spot date will be April 5, which means 2 months 15 days. Now they've calculated and given you. We need to compute the forward rate for June 20, 2 months 15 days. Here you have to do interpolation. That's the question, which means see what they have done. 2 months swap points given na, and 3 months swap points given, which means, see, very simple, 2 months swap points is given, right? That you will consider, you will add and get the direct code for April. Today April 5 is there, assume. After 2 months, May 5, June 5 you will get. The balance 15 days swap points, how to, apportion the swap points, you need to see that the 160 and 186, the difference you calculate, 160 minus 70, this is 90, and 186 minus 90, you get 96 na. This is the differential swap points which is for only 1 month period, starting from the end of 2nd month and till 3rd month. Are you all understanding what is happening? So this 1 month swap point we can compute. Okay, 160 minus 70 and 186 minus 90, you will get 90 bar 96. But this is not 1 month swap starting from today, it is after 2 months, which means 2 months you will consider the first 2 months you will consider 70, 90 as such, you will add it, and balance the 90, 96, the 3rd month portion is there na, you apportion divided by 2 and divided by 2, you will get it totally, you add the swap points, okay, you will get the forward rate. Shall we see the solution? See here what they have done. For swap points for 2 months, 70 and 90 you will add, I told you na. Then swap point for 3 months, 160 and 186, differential amount is 90 and 96. This is the swap points for the additional month. That you will reduce, divided by 2, you will get half of this, because only you need for 15 days. This 45, you add it for 2 months swap points. 70 plus 45 gives you 115, 48 plus 90 gives you 138. Are you understanding? So total swap points for 2 months plus 15 days, 115, 138. This I will add. Okay, what they've first part ascertain swap points alone they have asked. Okay, next step they have asked determine foreign exchange rate for June 20. Just add the swap point to the bid and offer current spot rate. You will add this swap points which you found out here. Here also if you see 115, 138, how you should find 0.0115. Okay, last 4 digit you should do that. So 66.264 and 67.6083 you will get. Next, annual rate of, compute the annual rate of premium or discount. How to find? Okay, premium or discount, very simple. Forward rate minus spot rate divided by spot rate into 100 into the period, which means a 6 months spot. So if you see this, if you want it to be annualized, what you do 12 by 6. Are you understanding? Annualized forward rate, forward premium or discount you should find. If it is discount, very simple, you will get the same thing. Forward rate will be, okay, quoted in, see, today is 50, tomorrow if it is 46, it is understood to be, it is quoted at discount. Are you understanding? So anyway, now Here rate, see spot rate is same, foreign exchange rate for June 20 we have got. Now what is the premium? We already know. So forward rate minus spot rate we have found out here, numerator. Are you all understanding? Now here what they are taken, now for numerator you will consider this, no issue, but while considering the denominator what they are saying, consider the average rate, consider the average rate. This D is there now, the total which you got, okay, the A plus B divided by 2 you should do. They are saying you should naturally, generally, okay, the premium or discount will be computed over and above the spot rate. The forward with regards to spot rate only you will be considering premium or discount, it is quoted at premium or discount generally. But okay, what happens in this case, they are specifically asking to take as average rate, which means spot rate plus simple average you will consider, spot rate plus forward rate divided by 2 if you do, you will get the average rate and solve the question. Are you understanding? So average rate na, very simple, okay, 66.2525 plus 66.2640 divided by 2 you will get the denominator. Are you all understanding? This rate you will get, and this is the premium, okay, forward rate minus spot rate, this is the premium, but this premium is for 2.5 months, 2 months and 15 days, okay, 2.5 months, but I need annualized premium or discount, agreed? So which means 12 by 2.5 into 100 if you do, you will get this percentage. Are you all understanding? This is a solution. Okay, take question number 6 for discussion.